Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. Shares of Digital Realty Trust are down sharply from their all-time high, and a lot of investors are looking at the company with trepidation and concern going forward. Is Digital Realty Trust a high-yield buying opportunity, or do investors need to step carefully? I'm Jason Hall. This is The Smattering. I've got Tyler Crow here with me to talk about Digital Realty Trust. But this is a stock that really got tied up with the tech speculative run-up we saw about a year ago, and it's come crashing down to earth. What's going on? What's your view here?
I think it's a little bit of a misconception of like what it means for the tech industry and what it is as an investment. You know, whenever you hear about, you know, the explosion in data and how much we're going to use and how it's going to grow exponentially, you know, everyone tends to correlate that with explosive growth for every single investment that they make. When that's not really
10 times more data doesn't mean 10 times more data centers.
Or 10 times more revenue for anybody. And that's the thing that
Right.
you have to keep in mind here when you're talking about Digital Realty Trust, is it's a realty it's a real estate company that pretty much can only grow as fast as it brings on new facilities, and also fills those facilities with tenants. And at the same time, as those tenants turn over their equipment, there's a kind of this erosion of revenue in the data storage industry, where it's, you know, revenue per watt is typically how they price their contracts, is by the watt used, the amount of power that you use. It's kind of a proxy for square footage.
It's the march of technology, basically,
Yeah,
right?
right.
Is every unit of power that is taken in generates more
Processing
compute.
power, right?
Right.
So
that's basically what you're talking about.
Basically, kind of data storage, kind of in a weird way, falls down the commodity cost curve versus you know, not paying a premium. And so because of that, this isn't a hugely fast growing company. Over the past 5 years, you know, Digital Realty Trust has grown its dividend by 20%. That's respectable. But it's certainly, if I am making bets on explosive tech growth and just the real estate behind it, that's not the kind of thing that's going to correlate with that kind of growth. Now, as far as its dividend, the other thing we need to take into account too is we are investors and we command a return, and there is a risk premium to returns. Right now, you know, treasuries and things like that have considerably higher interest rates. And so with dividends should have a premium to that risk, because it is inherently a more risky thing than a U.S. government treasury bond.
It's one of the reasons why it's still been a pretty good investment over the long term from its shareholders, and it's grown its dividend every year. I think this is going to be the 17th year in a row it's grown it since it went public, because scale matters, right? And they've been able to leverage that scale with the largest tech companies in the world, largest companies that need that data, having proximity to the largest population centers, right, where the data is going. And that's proven. That's been a big benefit, and why they've been able to constantly grow that funds from operation over time. Tyler, you mentioned interest rates and yields for bonds. They've also benefited from the low cost of capital environment as a growing company, because it means the debt, they've got $16 billion in debt. They were able to take a lot of that debt on at very favorable interest rates, and were able to issue equity at favorable multiples over time to fund a lot of their growth. And I do think that investors should realize that their cost of capital is going to be higher. It's going to put some pressure on their ability to grow. Part of the antidote to that is multiples for some of the real estate. Maybe they'll be able to get better multiples as they expand going forward, right?
Yeah, and I think the biggest takeaway I want to emphasize here is it doesn't make it a bad stock, right? Like it's just
it's about having the right expectations, right?
Knowing what you're getting. You're going to get a dividend that's 5%, maybe a little bit higher depending on when you buy it, a little bit lower, with, you know, some modest dividend increase, which for a lot of people is a wealth generating opportunity.
Have the right expectations, and I think it can be an attractive business.